Hello, this is problem 4-2. I know I started it in class, but I'm going to go ahead and just start at the beginning. So we have the whole problem on one. And if you hear weird chewing going on, it's little Pico chewing on some heavy duty plastic bone that he loves. No idea why this dog likes to eat plastic, but he does. Okay, so let's see. Vinton purchased 80% of Crandall for $425,000. I know most of y'all have probably already done this, and you can just fast forward past this part. All right, their assets. Every fair values are the same as book values. Any differences are all goodwill. All right, so assets had 500,000, liabilities are 100, so the net assets are just 400,000. This is different than the key. Remember, the key said they paid 450, so it's going to be off a little bit, or different is a better word. Different than the key. Copy this one down. And then subtract. Copy that across. All right, and that equals the goodwill. So this is goodwill right here. Okay, we'll do the intercompany stuff. Intercompany profit deferral and whatnot in a minute. We'll do income distribution in a minute. Let's see what we're supposed to be doing. I think we've done that in class. That might have been where we stopped. Maybe we did a couple journal entries. I don't remember. I think we did do a couple journal entries. All right, we're supposed to prepare the worksheet to produce the financial statement, include value analysis and determination and distribution of excess, and the income distribution schedules, and then do the formal consolidated income statement for the year ended March 31st, 2017. Okay, so one thing to recap on that I didn't say a second ago, let's see. They're using the cost method, and I don't think it really told us that anywhere. However, you might notice that on their trial balance down here under income, they don't have any subsidiary income. All they have is dividend income. Well, you don't have dividend income if you use an equity method, so they must be using the cost method. Okay. All right, and then what else do we have happen up here? All right, this is information about beginning and ending inventories. Intercompany merchandise sales were summarized as follows. So for the year of 2015, basically, Benton sold to Crandall and Crandall sold to Benton. So we have it going both directions. The parent sold to the sub and the sub sold to the parent. So we have what they sold, what their gross profit rate is, and then how much is in the beginning and ending inventories. All right, also on March 31st of 2017, Benton owed Crandall $10,000 and Crandall owed Benton $5,000 as a result of intercompany sales. All right, that's at the end of 2017. I didn't say anything about 2015 to 2016. We'll see. All right, Benton paid $25,000 in cash and dividends on March 20th of 16 and 17. Crandall paid its first dividend on March 10th of 2017, giving each share of outstanding stock a 15-cent cash dividend. Trial balances at March 31st, 2017, so it's the end of 2 years that we're doing the stuff for. Okay. All right, let me fix this. This is this 450 investment in crayon. See, it's not even crayon. It's supposed to be Crandall. It's kind of annoying. All right, this is supposed to be 425, so I'm going to change that to 425. And then I'm just going to add it to the land. And we still zero out, so we're good. All right, so elimination entries. First thing we need to do is bring the investment up to what it should be after 2 years if they had been using the equity method. So we need to do a CV entry. All right, and what happened over here is Crandall's retained earnings is currently 140,000. Their retained earnings at the beginning, like when they were bought at the beginning, it was 100,000. So it's increased by 40. And we need to increase our investment by that 40,000. All right, so it's investment in Crandall, and it comes out of retained earnings of the parent. Oh, you know what? It's only our 80% of it. Sorry, I forgot. Oh, I put the line spot too. Okay, then we have these dividends somewhere. These dividends that we need to take out. So we're going to have a CY2, debit dividend income, credit dividends declared, Crandall 24. All right, then we need a normal elimination entry. Stock of Crandall, paid in excess, retained earnings, and it's all going to be at 80%. So Crandall is 200,000. Paid in excess is 100,000. And retained earnings is 140. My offset is the investment. Then I got to put goodwill on. It goes to the investment and the retained earnings of Crandall for the NCI. Right, goodwill was 131,250. And it should tie to these two numbers right here, 105 and 26,250. I do believe that adds up. Okay, so those are the basic ones. Now we need to start adding in the new stuff. All right, we got to look up here because we got to eliminate the sales. So I'm going to have two sets of everything since parent sold to sub and sub sold to parent. We're going to do them individually. All right, so eliminate the intercompany sales of the parent. You know, I gotta figure out what we're doing here. All right, this was 15 to 16. This is 16 to 17. So it's this cell right here that we're looking at because we're doing at the end of 17. So we're doing the 16-17 one. So the 32,000, and it's debit to sales and a credit to cost of goods sold. All right, then I need to do the same thing for the sub. It's the same entry, sales, cost of goods sold, and that's 30. Okay, then this is March 31st of 2016, which is the beginning inventory for 2017, basically. Okay, so these are things that are in the beginning inventory. So I need to limit, or I need to release those profits actually. So I'm going to have a beginning inventory for the parent. And it's retained earnings of Benton, retained earnings of Crandall. Oh, well, if I do the parent, it's just all Benton. Sorry, it's not split. It's retained earnings and cost of goods sold, and it is going to be $4,000 times 25%. Oh wait, I'm looking at the wrong. Benton to Crandall, parent to sub, 9,000 times 20%. And now I need to do it for the sub. Begin inventory of the sub. And this one is split between Benton, the retained earnings of Benton, and the retained earnings of Crandall. And then a credit to cost of goods sold. All right, so let me write this up here. This was the 9,000 times 0.2. So this one needs to be the 8,000, not 8,000, 4,000. 4,000 times 0.25. And it's this right here, 4,000 with the 25% gross profit rate. All right, and then that's split 80-20. Between the retained earnings of the parent and the sub. All right, so that was the beginning inventory ones. Now we need to do the ending inventory, which are these right here. All right, so for ending inventory, you're going to increase or debit cost of goods sold, and you're going to reduce the inventory balance back down to just what its cost actually is. All right, so 6,000 times 0.2. And then you have to do the same thing again. Same entry. It's going to be 3,000 times 0.25. All right, and then we need to do the intercompany accounts payable. And it's right here. Bitten O Crandall 10 and Crandall O Bitten 5. So we're going to do it twice. Once for what Bitten O what Bitten O's Crandall. So debit account payable, credit account receivable 10. And then the same thing again for the sub, and it's for 5,000. Okay, I think that's it for the eliminations. And we have to go up and do the worksheet. So I'm actually going to pause and go do the worksheet. I don't think you'll need to watch me do all that, but then I'll show it to you when it's done. Okay, so I have the eliminations in here. They tie out down at the bottom, so I'm assuming I'm on the right track. So let's go ahead and finish the worksheet together. Freeze my panes. All right, so consolidate income is the next column I need to do. That's all about. All right, so I have 880 plus 630 minus the 32 and minus the 30. Why do I have a different number than the key? 880, 630, 32, and 30. I have all the same stuff. All right, let's just finish it and see what happens. Cost of goods sold. That plus that minus, oh, I already know why. That's actually be a plus. Let me start over. That plus that plus the debits minus the credits. All right, let's go back to this. These actually need to be pluses. Don't y'all always have the issue with those debit and credits being pluses and minuses? There. Okay, that's what it should be. All right, other expenses, just add them together. This should zero out. Dividends declared does not go there, but let's go ahead and put it over here where it goes, so I will not forget it. This one goes in that column, and the 25,000 goes in Crandall's column. Okay, so that's good there. Let's total this out. Okay, so now we need to split that between the NCI and the controlling share. So I'm going to go up here to the income distribution schedules. I'm going to unfreeze my panes. All right, so we have 630 minus 504 minus 81 is their internal. 630,000 minus 504 minus 81,000. So their internal is 45. All right. Then this 750 comes out of the subs. All right, both these numbers affect the sub down here. All right, so they're going to have a debit or reduction. Unrealized profit. Beginning inventory. And then they're going to have a realized profit. This is beginning inventory. This 750 is actually the ending inventory. Realized profit. Beginning inventory, and it goes on the credit side for 1,000. So add up the two credits, subtract the debit. 42.5, NCI gets 20% of that. And the controlling share is the difference, or 80%. Oh, oh. All right, internally generated income of the parent, 880, 704, 930. Minus 704 and minus 130. Okay, they're going to get this 36.2. But then we also have to do this same thing. Like this was from there. Now this one gets the 1,200 and the 1,800. 1,200 on the debit side, 1,800 on the credit side. I'm just copying this. explanations. And everything's there, so I think I can just add it all up. $82.8. All right, so that 9050 and that 82.8 should come down to here. 9050. Oh, it needs to be minus, sorry. And minus 82,800. And I do believe that will tie out. Okay. So then this, let me put my freezing my panes again. All right. So the 9050 needs to come over to the NCI column. The 82.8 needs to go to the control retained earnings column. All right, control retained earnings for Benton. Let's go ahead and do that. That's easy. This one minus this one should get bigger. And it's going to be a little different from the key because, you know, this, yeah, it's different. No, it should be the same as the key. Why is it a different number? Oh, hello, because it has this stuff right here. So I need to add debits. Does that. There. That is correct. Right, then to Crandall. Just copy down, and then this one, that, 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 that. Add up the NCI column. Comes to there. Got this whole column, so let's go ahead it up. Goes to there as well. Let's do the rest of these. Inventory plus, sorry, investment, this plus this minus this. Hopefully that worked. What's this? Building. Bill. Accounts payable. Did it go the right way? Yes. Payable. Stock of bitten comes on over. Excess of bitten comes on over. That should be it. Let's sum it up. I am not holding my breath. But we'll see. Dude, seriously? Pausing while I find my mistake. I found it. It was super silly. Goodwill, the parent has goodwill on their books already from somebody else, and I didn't add it in. I just picked up what we added in. There we go. And now it zeroes out. All right, then you have to do the income statement, and it comes from this column right here. So you just make an income statement out of that. It's like sales, cost of goods sold, expenses and whatnot. Y'all can do that. It's not that. That's pretty straightforward. All right. That's it for problem number 2.